So what we actually did was we pre-recorded a little interview with Mary because we didn't want to deprive you people of her policy views, and then Pat, Trey, and I will discuss it afterwards. So first, Trey, why don't you start us off, give us a little introduction, Pat you, and then we'll play the video.
Great. I was hoping for some really energetic music, but I'll take the Speakeasy music.
We'll have to bring the energy.
That's right.
Yeah.
So Trey Maust, co-founder and executive chairman of Lewis & Clark Bank, a bank that was formed about 17 years ago. While I have an affiliation with that institution, most of my time is actually spent, at least over the last decade, really understanding the ins and outs of the industry, both from a regulatory and a policy perspective. I spent a lot of time working with the federal agencies as well as the state banking agencies or chartering and supervisory agencies at each of the states, as well as various industry efforts. One of those being an effort that I led that now covers about 70% of all the U.S. deposit accounts, so pretty broad, but very narrow scope resilience effort for the industry. So happy to talk about. I have some, I guess, some very strong views about the impact that different administrations have on the regulatory agencies, which really build and create the landscape under which we operate. And so it's really important to understand the ramifications of who gets elected into at least the executive branch of government.
Yeah. Pat?
Yeah, thank you. Good afternoon, everybody. Appreciate so many people sticking around. I know the bar is calling, but I was super excited to get invited here to speak. And I thought, you know, here's a group of folks that really want to hear what I have to say. And then they put me on a panel titled Shh. That wasn't that bad. Come on, guys, get into this. Thank you, thank you. But unfortunately, you're going to have to listen to me for 44 minutes and 22 seconds. But I'm Pat Ryan, helped found a commercial bank, community bank based in central New Jersey. We're a pretty traditional, plain vanilla community bank. We focus on deposits and loans. Most of what we do on the lending side is commercially focused, from small businesses up to lower and middle market companies. And you know, we're very interested in seeing how the political dynamics change, and obviously it has a big influence on our industry. And we have our own views about what we hope might happen, but at the end of the day, it obviously has a big impact on what all of us do every day. So looking forward to a great discussion, and thanks for having me, Mike.
Great. So before we play the video, I just want to intro Mary a little bit. As I mentioned, she's EVP and Senior Policy Advisor at Stevens. She's also Vice Chairman of RXO, which is a fairly large truck and freight company down in Dallas, which is where she's based. From October 2018 to January 21, she was the Senior Advisor to the U.S. Secretary of State. And she was also a very accomplished member of the Wall Street Journal Executive Board. So way more interesting than me. So with that, let's play the video, Autumn. Thank you. And then we'll talk about it on stage afterwards. Hi, Mary. Thank you for being with us digitally today. What's the ideal outcome in November for the kind of the community and regional bank universe as you see it?
It's not just a question for banks specifically. It's a question of economic growth writ large. And in fact, you know, the word growth has not really been on the agenda. I mean, clearly, I think on the Republican side, you do see kind of a classic conservative, smaller government, lighter regulatory touch agenda, and a promise to unleash our energy industry, which is a big employer in America, obviously important to many industries, those cheaper inputs. But you know, on the other side, you see President Trump talking about more tariffs, although I don't believe for a second that he'd put 10% tariffs across our entire economy. I think that's a negotiating tactic. On the Democrat side, you haven't seen a lot of policy specifics out of the candidate herself, but I would encourage everybody in the audience to go read the 90-plus page party platform manifesto that was released just in these last weeks. I mean, it's a potpourri of tax hikes, corporate rate 28 up to 28%, higher estate taxes, stock buyback taxes, a doubling of taxes on foreign earnings, the elimination of carried interest and stepped up basis. Americans for Tax Reform estimates it's about a $5 trillion increase in tax over the next decade, and they propose to take that and to essentially dole it out across various interest groups. Banks not really being one of them. So that, to me, is a recipe for, again, going back to kind of the Obama era 2% growth profile. We start to look a lot more like France, rather than the trajectory that we were on under Trump, which was moving a lot closer toward 3. I mean, we could achieve easily 4 or 5% if we had the right policies in place. So again, I wouldn't think of it primarily through a bank lens. This is really a question of who's going to stimulate growth, who's going to lift the regulatory burden off of our productive industries, who's going to encourage risk taking, and I think that answer is pretty clear.
One thing I think for the executives in the room that's really close to heart and top of mind is, and I think would be helpful to hear from your perspective on, is how much upheaval can you expect in terms of kind of key leaders in bank regulatory or bank interest groups and industry and things of that nature. Can you give us a little bit of a flavor of not necessarily like who you expect to be appointed, because obviously that will depend heavily on who wins, but how much change do you think could happen at some of those positions that can be very impactful for this group?
Well, there's always significant turnover, and for the banking community, obviously that's the Fed. That's the CFPB, and that's Treasury. And you would, I think it's safe to say, see significant changes at all three. Again, we can't predict the future, but we can look at the past and try to make an educated guess about the sort of individuals who would run those agencies under a Republican or a Democrat administration. Maybe we'll start with the Democrats. We've seen reports, again, unconfirmed, that we're really just making educated guesses here. Gary Gensler was in the running for Treasury Secretary. We've seen what he has done at the SEC, very activist agenda, and in fact, so much so that he's been kind of pulled back by the courts. So I think but him landing a significant position like Treasury or even staying at SEC, I think is very possible. You saw, again, hearkening back to the Democratic Party platform, a commitment to expand the Consumer Financial Protection Bureau. Again, in prior Democrat administrations, we've seen that bureau weaponized to go after financial institutions like payday lenders. On the other side, again, for Republicans, I talk maybe about the Fed first. You had individuals like Kevin Warsh, who's, of course, on the New York Fed board during the crisis back during the Bush era. He's a professor out at Hoover, his name being thrown around. I think that would be incredibly positive for the Fed. I think he's a very sensible person. I'd encourage everybody to go read his op-eds in the Wall Street Journal. He writes about once a month for the editorial board there. Treasury is, usually somebody from the street. Jamie Dimon has been mentioned as someone that President Trump might consider for that role. I'm just, again, trying to make educated guesses. I think if somebody tells you they know for sure, they're lying to you. I mean, you can't really say for sure unless you're the candidates themselves. But I think the universe from which these candidates will be drawn is pretty obvious.
After focusing on something so micro, let's take a step back. This is a point in time, right? The election in the U.S. when we're very inwardly focused. We're worried about our problems, we're worried about our candidates, we're worried about our taxes. But banks historically, I'm not saying anything too crazy here, have done well when the economy's growing, and when that economy's contracting, it's a tougher environment, right? And so what are a couple global issues, especially given your background and exposures there, maybe one or two key global issues that you draw attention to for this audience that they should be mindful of as they think about, the impact potentially to the U.S. economy and future growth?
Yeah, thanks for the question, Mike. I'm often asked about events abroad, whether it's the Ukraine war or the relationship with China. And one of the things that I tell our clients is you really need to see the world as it is and not as you wish it to be. And we also need to really shake a bad habit, something I call strategic narcissism, where we believe that what we do is the thing that's going to kind of change the environment in which we're operating, and that's not always true. So that's just a couple foundational things. Another kind of foundational idea, which I don't think enough executives think about, is that we also often talk in bilateral terms, for instance, about, say, the U.S.-China relationship or, the Russia-Ukraine war. That's just not fundamentally how the world operates. It's not really our bilateral relationship with China. You have the world starting to form blocs and alliances, much like they did in the Cold War. So it's not really just China we're dealing with. It's China, Russia, Iran, North Korea, Pakistan, versus a free nation alliance plus allies and partners, places like Vietnam, for instance. So we need to understand that the world is changing, the balances of power are changing. In terms of key issues in this new world that we are entering, I think we're in a transitional period. Couple of themes that might be of interest. The first is that our stance toward China and China's economic predations is not going to change. Whether it's Kamala Harris or it's Donald Trump, not going to change. Not because of us or because of what we want, but because of their behavior and because of the nature of their regime. So I would anticipate a continuing trend of restrictions on exports of sensitive materials, for instance, a continuation of efforts for us to do trade deals that allow us to source strategic priorities, whether it's pharmaceutical inputs or semiconductors or rare earths, for instance. I would also expect the next administration to direct government money to try to build up those industries at home. You can take issue with doing that as a conservative. I don't like that. I'd rather have tax incentives, but that's just not the direction that either party is going. I think secondly, on a big theme, don't neglect what's going on in our backyard, and by that I mean not just Mexico but also Canada. I think you're very likely to see Pierre Poilievre win election. That's a big change in Canada. He'll be much more pro-entrepreneur, pro-risk-taking. I think that'll be terrific. Canada's a big trade partner. But also in Mexico, you have a new leader there who every indication is not really going to get a handle on the kind of gang war or cartel problems that they've had. And so we'll see what that relationship looks like, but this nearshoring trend is here to stay. But whether or not it stays in Mexico is, I think a question to the degree that it has been moving there. I guess lastly, again, stepping back big picture, and I'm sorry we don't have more time, but the chaos that we've seen in the world in the last couple of years has been due to the reduction in U.S. deterrence. They're not afraid of us anymore. And so the person who populates the White House are not just going to be important for economic growth reasons. That person is either going to restore U.S. deterrence and we'll get a calmer world, or we're going to continue to see the erosion of U.S. deterrence. And we could be in a much larger conflict than the conflicts that we're seeing today, and U.S. troops could be involved. So it's a very important election. I know it's a temptation to focus on the latest FDIC diktat or who's going to sit at the top of which agencies. But it really is a very significant choice that everyone is facing in November, with likely very different outcomes. So I've got friends on both sides of the aisle. I try to stick to the facts, but I don't think it's an exaggeration to say that this is an incredibly important election for everybody in the room.
Great. Well, thank you, Mary. Stephen's lucky to have you. I really appreciate the perspective. I think there's a lot for us to discuss in the room following this video, but thanks for joining us, and definitely look forward to talking more. And I know it's a busy time of year for you, so appreciate the time.
Thanks for having me, Mike. Sorry I can't be there with you in person today.
Things I love about that video is how the heck are you guys really supposed to craft a risk strategy with all this stuff going on that's out of our control? And it got me thinking, and what I really kind of realized was, how much of risk management is really just crisis response, and how your organization really you have a building has its emergency evacuation plan, right? You don't really know. One thing I've always heard is bank regulators are trying to fix the last crisis, right, with rules today, and then years down the road that spawns the next crisis. But Pat, maybe we'll start with you. What do you think about that statement just in general? When you think about enterprise-wide risk management, and you have these stimuli like an election that could really change a lot of things far out of your control. I mean, how much of it is trying to plan for certain outcomes versus just kind of getting your organization ready to react to a lot of things that are really unknown?
Yeah, well, listen, I think the biggest thing is you got to make sure you're not overly exposed, right? You know that there are these potential, quote, extreme outcomes, right? I would argue they're probably not extreme as maybe it sounds when you listen to the rhetoric, right? The reality of what happens once people get elected and how much control they really have to do what they want. But at the end of the day, you got to make sure you're in a position where whichever way the coin toss, right, 50-50 polling right now, you got to make sure you're not going to get hurt too bad, right? You take a position, you want to make sure you can do well in either environment. And so risk management starts with limiting your exposure to these different outcomes. And then it really comes back to not only the obvious coordination across the units, right? We listened to some of the speakers earlier about the right side of the organization doesn't know what the left side is doing and vice versa. Thankfully for us at $3.6 billion in assets, we don't feel that we're so big that we're operating in silos and it's hard to get people together on a regular basis and talk about what we're doing. It sounds pretty simple, but in some ways it is, right? At the end of the day, the silo mentality emerges when you're not getting groups together on a regular basis to talk organizationally about what's happening. But then it's really about understanding not so much the scenario, but what does the scenario mean, right? So at the end of the day, if a certain event is going to put pressure on liquidity, we'll make sure you're prepared to deal with whatever that liquidity issue that might emerge, right? So you're not sitting there trying to predict bad events that will happen. You're sitting there trying to say, all right, how do we make sure, geez, if rates go up 500 basis points in 18 months, we're not overly exposed, right? And you don't necessarily know why they're going to go up, whether it's driven by an event or an election or something else. You're just managing your organization so that if those quote unquote tail events emerge, you're in a position where you can handle it. It's not going to be good. You're not going to like it, but you're not going to sink the ship over one potential outcome.
How about you, Trey? Any thoughts about how particularly siloing risk? I don't know, thunderstorms rolling in here. What's going on? But we're going to talk.
Ominous.
Really. Yeah. There's managing the kind of. I touched on this in a couple different panels earlier, with Scott and Brian about interest rate risk. But how do you make sure when you're thinking about your enterprise-wide risk management across the entire bank, you don't have siloed thoughts or views or actions being taken, and that the interest rate people know what the credit people are doing, and everyone's kind of rowing the ship in the same direction.
Yeah, it's interesting to think of how much effort we put into practice in the banking industry with such small organizations undertaking such large enterprise activities like enterprise risk management. You wouldn't find that in any of our, say, commercial clients of similar size. A 50-person shop is not going to have the level of enterprise risk management and just daily risk management that banks do. There's a reason for that, and I want to touch on a couple things. One is the daily blocking and tackling and optimization, and the other is the extreme scenarios that we were just talking about a couple minutes ago. On the daily blocking and tackling, and your question about the silos, one tool that I know a lot of us find very useful is the enterprise risk management dashboard. So just understanding a snapshot of where are my headline risks across the enterprise and down through all the various risks that can be potentially exposing the bank. All the way, if we take it from a CAMELS component level or a consumer protection level or just operational, down the rows and then across the columns are the different functional areas. And that heat map is going to change from quarter to quarter, and just understanding where those red areas are, where the green areas are, really allow, we'll say, those charged with governance, so the board in particular, to understand what are the areas we can really push into a little bit harder, get a greater reward for essentially the level of risk that exists there, inherent risk, and where are the areas that we really need to double down and ensure that we have risk mitigation policies, practices, procedures, et cetera, in place, and maybe pull back a little bit. And going back to the political environment, and depending on who's in office and the agency heads, it's going to have an impact on where we might see some of that inherent risk taking place within our organization. The one, why do we do this? Obviously to optimize for risk reward, but and to have some visibility into not just today's risks, but where they're going in the future and where they've been from a longitudinal perspective. But I've thought about this a lot in terms of why do we go through these exercises and why is it so important that we have this in place? And I thought, we're the only industry that you can hit either an individual organization or the entire industry with a massive sledgehammer, and we don't fall apart. Now, a couple do, and we've been through the financial crisis, we've been through S&L crisis and various other, say, minor banking crises. But think about how many banks survived that. And a lot of that I'd attribute to, of course, the enterprise risk management and then down through the various silos. I don't think, unfortunately, the individual silos can manage that as well as board level and then driving that down from the top.
As banks, I think most banks in this room are probably fairly dependent on spread to generate earnings, right? I mean, that's kind of the 50 billion and less. That's pretty typical. I want to talk for a minute about how a political event like the upcoming election can be challenging from an internal budgeting and forecast perspective, right? I mean, you guys get pressure from investors, board members, other stakeholders to kind of convey the financial future of your organization, right? I would imagine it's incredibly difficult to do that, though, with the degree of confidence when there's two very you heard Mary discuss it, there's kind of two very different paths that we can go on here, right? So I guess, just to kind of get us started, I think a great analogy was when Trump got elected the first time and there was the tax reform. There was, at least on Wall Street, there was a ton of sensitivity analysis going on about what banks' earnings would be, how it would impact everything. But Trey, maybe we'll stick with you and start with you on this one. But can you talk a little bit about how you have to try to be flexible in your budgeting and forecasting procedures to kind of accommodate for some of this uncertainty? It's a little unique. It comes every 4 years. So I feel like sometimes it's worse because you kind of dust it off and forget about it, and then you're like, oh crap, we got to deal with this. But I'd love to hear some thoughts.
Yeah, and I think about it from the standpoint of resource allocation. So certainly from a budgeting perspective, that will drive the resource funding for the resource allocation. If I think about the differences between maybe administrative focuses, when I've looked at, at least historically, we'll say a Democratic administration versus a Republican administration, not to say one is better than the other in the grand scheme of things, although I've got my own personal opinions, but from a banking industry perspective, it's important to understand the impact it has on the chairman of the FDIC, the Office of the Comptroller of the Currency, so who actually heads that up as the comptroller, who is the director of the CFPB. All those are appointed positions, and then 3 of those are actually on the board of the FDIC. So you then get a very concentrated group that drives that particular agency. So in addition to what Mary had talked about, it really gives different executive branches. So if we're talking about Republican versus Democrat, the ability to affect change, and we certainly are experiencing that. So from an empirical standpoint, I wanted to share just a very stark contrast between administrations. And that data point is the Conference of State Bank Supervisors Community Bank Sentiment Index. And it's not so much the overall sentiment index. It's actually, that tracks very well with what's going on with the economy. And so when we're talking about different policy matters that affect the economy, those are some differences between administrations, but for the most part, they stay up fairly high. And as long as the economy is doing well, those stay high. The one stark contrast is regulatory environment. And so just the sense that I have the ability to pursue something or I am required to contain. And from 2021 until now, that number out of 100 has been right around 20. And it was as high as 70 or 80 prior to that. And just that stark contrast impacts, obviously, the decision-making that we conduct. And so I guess I encapsulate it into 2 things. One is, if it's a Republican administration, it's highly likely it's going to be more focused on, as Mary had indicated, growth and advancement and some innovation and a little bit of risk-taking, I think within reason, because we have to be able to survive the sledgehammer. If it's a Democratic administration, highly likely it's going to be more about containment and, interestingly enough, and we've seen this certainly with the FDIC, activism. So anything that can affect policies that are important to that administration are usually done through the agencies rather than more of a hands-off approach that allows the industry to take a little bit of a chance in some areas and actually grow.
Pat, when you think about kind of functionally, 1 + 1 = 2, right? So like if the tax rate's going to be 28%, it's 28%. If it's going to be 32%, it's not like you get a bigger pot to pay for all the stuff you were going to do, right? Like something's got to suffer. Either your bottom line profitability suffers, or maybe it's your innovation budget that suffers. Like the money in, money out equation doesn't necessarily change. So realizing it's a bit of a theoretical question, but how do you kind of handicap where some of those pain points might be? Like let's say in an exercise, we have a Democratic White House and corporate tax rate goes up. I would imagine you would hope to be able to hold the line somewhat on your profitability through some actions, but maybe not. I mean, how do you think about, especially there's a lot of discussion today about earning your cost of capital and all those things. I'd love to hear some thoughts on managing that.
Yeah, well, first of all, I agree with what Trey said. There's sort of two big variables, right? There's tax rates, and then there's regulatory climate. One of those is sort of an immediate and significant impact, and the other one's more of a slow benefit or a slow burn, depending on which way it goes. But that's almost nearly impossible to budget, right? Most organizations, I know we do a 1-year budget and we do a 3-year budget. The 1 year we spend a lot of time, we try to get it pretty precise. The 3-year, equally interesting, but obviously the further out you get, especially on some of the assumptions you make, it gets a little bit tougher. So at the end of the day, we're going to run a budget based on where we think tax rates are and where they're going to be. And if they get moved, we're going to get hit in that year, positive or negative, because it'll be too late to really do much about it once it happens. On the regulatory side, you're not going to all of a sudden just add 5% to your non-interest expense because you have a Democratic regime that's going to theoretically make life more difficult. Now, you might do a little something more in years 2 and 3 because you know that in all likelihood you're going to need to add some staff and you're going to be under a higher level of scrutiny. But at the end of the day, for community banks that are spread lenders, right, what really drives the budget? It's the level of rates and it's the shape of the curve. The level of regulatory scrutiny as it relates to the impact on my budget on an annual basis is a very small variable as it relates to how I'm going to make my money. So I'm not all of a sudden tax rates are higher, so let me go try to find ways to make more money. No, I'm trying to find ways to make more money every single day. And I'm not waiting around until the tax rates go higher to look for those opportunities. So to your beginning question, yeah, to some degree, you just got to live with it when it's a quick hit like that and you didn't know what it was going to be. It is what it is. On the regulatory side, I would argue strategically, the regulatory climate could actually become an advantage for you, right? The more scrutiny that's out there, the stronger performers will rise to the top, right? It's almost like a world of grade inflation, right? If everybody gets an A, who are the best students? Nobody knows, right? When all of a sudden folks are getting put through the ringer, if you're showing you've got the right policies, procedures, and risk management platform in place, and the regulators like what you're doing, all of a sudden that becomes a strategic advantage. So while I don't root for it, because it's painful, at the end of the day, we feel like we've got good systems in place and it actually creates potentially some opportunities.
Yeah. I mean, historically, the banking industry is very cyclical, right? So like right now we're in kind of a tough liquidity, tough regulatory environment, but hopefully at some point there will be some alleviation of those pressures and some more growth. The question is it this cycle or is it 4 years from now? Hopefully, God willing, I'll be talking about the next forum, in 2028 and be optimistic then. But I wanted to transition from talking about some of the financial elements to the strategic piece, right? I mean, we had this sessions 2 before this that was specifically about embedded finance, and Trey, I definitely want to get your perspective there. But we're talking about these regulatory relationships, right? And out of your control, there's a very high probability that the people running these regulatory agencies is going to change in the next 3 to 6 months, right? To your point, maybe it's slightly for better, maybe it's slightly for worse, but they're going to change. I guess first question for Trey. How when you're trying to toe the line of being creative and innovative in the banking world, how do you manage your regulatory relationships in that context, right? Like it's got to be challenging to not know whether it's going to be constructive or kind of, for lack of a better word, like onerous, And so I'd love to hear some thoughts around that.
I think so. Just by way of context, in 2017 we launched a program with a trust company that is not vast, but it was using our charter in a way that a trust company could not. And the trust company did not have access to a Fed master account, couldn't be an ODFI or an RDFI. We facilitated ACH payments for one of the world's largest e-commerce platforms. You can guess which one that is. And it was a great program for a number of years until one of the board members of that trust company was able to secure a Fed master account, the only non-bank or credit union master account that was ever granted, because she was a former federal board governor. So a little bit of politics there. But anyway, I bring that up because
the right panel.
it was it was the door that opened for us to really look into the embedded finance business model and say, is that something we should pursue? And in 2020, we leaned really heavily into that space. And I'd say this is a bit of a kind of background to say it really depends. If we had taken that step, maybe very, very carefully measured and at the same size of organization we are today, I don't think we would have any issues stepping into that space. But we decided this would be a strategic imperative for the bank moving forward in terms of growth. It would move right alongside with the traditional bank. And we spent about 2 years ensuring that we had the risk management, the corporate governance, and the operational and technological practices in place to really run this in an effective and proper manner from a regulatory perspective. That went well for a very long time. We have quite a few programs. In aggregate, we have about $10 billion. Most of that's off balance sheet. And have obviously quite a few accounts underlying that. But we also got caught up post-Synapse, and I know that wasn't mentioned, but it was Synapse, obviously, from a middleware standpoint, and Evolve, and Blue Ridge Bank that unfortunately really tainted the perception from a regulatory perspective. And sometimes you just find yourself in an environment that's not favorable. And so that for us is, were we prepared for that? The answer is yes, but it's been very painful to work through that. And it's another one of, did we work through the risk management processes to ensure that we had really put the practices in place and the policies and the mitigating controls in place to really be satisfactory to regulators? So back to your point, it didn't matter how many positive conversations we had with regulators, if we could not make them feel like they had the ability to explain to Washington, D.C. what it is this bank was doing, we would have been in a world of hurt.
And Pat, community banking, right? I mean, I think it was Scott Hildenbrand at Piper made this point. You got to kind of know who you are, but that could change over time, right? So as you think about a bank like yours and how you're trying to be innovative, even if it's kind of over a long period of time or new vendors, maybe it's something in the bank partnership realm, maybe it's, a new commercial lending niche, or we see banks enter things like that all the time. How much can a political environment or regime impact your ability or desire to pursue some of these growth endeavors? Any anecdotes would be awesome.
Yeah, I mean, listen, in the traditional banking world, we've entered into some new lines of business. We've done it in a careful, thoughtful way. We've made sure we had the right policies, procedures. We launched some programs. We built them slowly. We had risk parameters. They're growing nicely. But, there was pretty much a clear playbook for how that would work. And at the end of the day, it always involves making sure that you're on the right side of things with the regulators and their, clean bill of health and a confident you as a management team. And so that side of it, it's been pretty straightforward for a while. Now, listen, the problem is, right, if for some reason something happens and you get on the wrong side of the regulators, everything you do comes into question. The things that were working very well for a very long time all of a sudden aren't working anymore. So you really got to make sure you're doing everything you can to stay on the right side of that line, because once you get to the other side, it's a night and day world that you have to live in. Now, where things are much harder, I think, and we're spending some time, and John Shepherdson's here leading our effort in terms of exploring opportunities within banking as a service, because we're pretty conservative by nature and because we've paid attention to what's in the press, we're going very slowly this endeavor. But this is a much harder opportunity for us to explore, because I don't know that anybody really knows where things are going to settle, right? There's clearly an expectation of heightened risk management, heightened compliance, de-risk it as much as you can, but exactly where you live on the dial, we don't know. So we're trying to go very slowly to figure out, okay, where can you live? What are those expectations? And then most importantly, based on the expectations, where can you make money, right? So you probably all remember a few years ago, the regulators came out and said, okay, cannabis banking's fine. As long as you do the 800 things on this list, you're fine, you can do cannabis banking. And so a couple of folks, you know, cheers to them for having the courage to do it, have tried to carve out a little bit of a niche. But the way we looked at it from our size at that time, there was no way to make a return on that because we could never generate enough income from the additional business to cover the cost that they just clearly laid out we were going to have to spend. Problem is we haven't gotten that list yet as it relates to the banking on the service world. So we're still sort of sitting here saying, hey, we're going to make what we think are smart investments. We're going to set up a platform we think is solid, but we're only going to do 1 or 2 programs before we figure out whether we're going to jump in any more capacity. And that, to me, is the biggest problem. It's always the challenge with the regulators. And then when you get into a political environment where there seems to be the tone from the top of, hey, let's go and turn up the heat on the industry, that obviously makes it a lot more difficult than if you feel like you have a more level playing field in terms of what you're dealing with.
So, I mean, it does sound like, not to put words in both your mouths, but you know, the current regulatory regime is slowing down innovation in the banking industry, you know, factually. But to your point, you got to try and keep the ball moving. It's just going to be at a very measured pace because you don't want to get upside down on the risk equation, right, and impact a very healthy part of your business because of something innovative you're doing on the other.
Well, and that's exactly right. We can't move too quickly there because if we do, we put the core franchise at risk. And today, the core franchise is 98% of the value of the institution. But that will change, right? I mean, Scott's point's right. The tastes of the consumers will evolve. The way banking gets done will evolve. And we don't feel like it would be prudent to not be investing in these areas just because we know we're going to need to move quickly once the dust settles. And so we're trying to strike that balance in terms of don't put the core franchise at risk, but don't put your head in the sand and pretend that banking is going to be the same 10 years from now as it is today.
Yeah. I'm going to be careful how I ask this next question because I realize it can be challenging to comment on it. But what has your guys' experience been in trying to maintain a close and productive dialogue with your regulators, even through periods of change, such as an election? Just kind of open it up. Anyone who wants to opine.
Well, listen, at the end of the day, the institutions are the institutions, but what matters is the conversation you're having with the individual sitting across the table from you. And that gets influenced by the tone at the top. So in most situations, when you have somebody who's sincere in the conversation, you can end up in a reasonable place. It's probably going to involve the bank adding some additional either staff or risk management or policies and procedures or other things. But you can get to a place that makes sort of sense. But sometimes if the tone on the top is, you know, one where I think we saw it in 9 and 10 where they were looking for things, right? They had to find things. They had to find enforcement actions. They had to find other things. And at the end of the day, it didn't matter about the conversation. Something was going to happen, and you were going to accept what that thing was, whatever it was. And I think, thankfully, despite the political environment in the 10 years since the Great Recession, I think things have been normal enough where you can generally get to a reasonable outcome. If, for some reason, the tone at the top gets significantly worse, then, you know, all bets are off.
Any thoughts, Trey?
Yeah, I was thinking about just our interactions over the years with the federal supervisory agency, so the FDIC in our case. And, you know, one of the things that really stands out, and I've heard repeatedly stated, is is, hey, I've looked at your file, so we get a new case manager, and looked at your file, and you always seem to do what it is you say you're going to do. Or you're a good proxy. I mean, the way I'd take some of the conversations is, you're a good proxy for us when it comes to decision making and remediation when there are, we'll say, gaps in their minds that need to be addressed or enhancements or recommendations. And I think that it goes a long way in just having confidence in management's ability to make decisions as a proxy for the agency. I can't imagine what it's like. I don't want to sound like that I have any sympathy or empathy for somebody in that position, but I can appreciate that they do have to explain to somebody. And if they've got evidence that shows, yeah, this bank always does what it says it's going to do, that has gone a long way for us whenever we're an outlier. And we have been an outlier more than once.
So to wrap it up, Trey, you suggested this question, and I really liked it for a bunch of reasons. But for one, I think we heard about a broad range of topics on this stage here today. And to kind of bring it all together before we hear from Johnny Allison in the next session here, what do you think the role of a bank will look like, let's say 10 years from now, in the economy? Trey, it's your question, so I'll let you start. Yeah.
10 years. I like to think about it in the 20 or 30-year time frame, but 10 years.
You know what? Fine, 20 years.
No,
wherever you're
that's too far out. That might be a little too far out. 10 years from now, if I think about banking, it was brought up earlier in the embedded banking panel, but thinking about for so many decades and centuries and potentially even millennia, we have had a fully vertically integrated supply chain where we are the retail storefront for the delivery of funds or the medium of exchange for somebody to do what they really want, which is to facilitate the economic activity that they're trying to buy, the good or service, exactly.
Yeah.
And same thing on the B2B side, so on the business side. And so I think about what we can do behind the scenes. And I think when there are still very large transactions, we'll be front and center. But we do have an opportunity in the next 10, 20 years to really drive behind the scenes the delivery of money to the actual point of economic activity behind the scenes where it's not even seen. So if I look around and think about electricity, we can do so many different things with power and electricity that facilitate everything we do in life. But fundamentally, it's the same fungible item. But once that's locked in, whoever's delivering it gets paid. Now, I know the concept of utility always gets brought up when this comes, but I can tell you it's a very high margin business, and I think it will be because we're not going to be a regulated monopoly in that sense where we're actually at price controls. At least I hope we don't. So I'll give you one example, and then I'll close out. And that is we have a program today where fleets, so it's a fleet management company, and companies that have fleets of vehicles have to constantly have spend cards that they provide to the drivers who run around, and as they're fueling it up, running through tolls, or maybe having service done on the vehicle. It could be a commercial vehicle, a tractor trailer, it could be a consumer, or just a regular passenger vehicle that's used for business purpose. And they're having to consolidate all those expense reports and allocate to the different vehicles. What if the vehicle itself is just the payment mechanism? And so we've facilitated the process to make the vehicle a payment method, so it just drives around, and as it's going to wherever it needs to go, with a toll booth, or it's a fuel station, or it's a service area, or consumables, it just takes care of it, integrates with the ERP or accounting system behind the scenes. And that enabled us to leverage our lending license, our issuing license with the card networks, money transmission license by virtue of our charter, just all these little functions that we have as banks to solve for something that made life easier for a business or a series of businesses. And that's where I see banking going in the future.
Well, let me start by saying we don't have that. We have somebody who will get on a bike and ride over to your business and grab your deposits if you need it. Now, in all seriousness, listen, at the end of the day, there's a couple things we know that'll be different in 10 years. There's going to be fewer banks. How many fewer, we don't know. Yep. There's going to be fewer branches, and there's going to be less activity in the branches that exist. But I do think fundamentally, and this is key to the community bank model, I think the relationship will still matter. I do think that there are segments of the customer base that don't care about relationship, but I do believe over time, I know it happened to me, that as you see all the ways things can go wrong, you start to realize how important it is to have a relationship and to have a banker involved to help you do what you need to do. And I don't see that going away. So I think the community bank value proposition stays 10 years from now. I think the community banks that are still here are going to be a lot bigger. We're going to be leveraging technology. The way people pay is going to change. But I still think fundamentally the bulk of the deposits 10 years from now will live within bank-like institutions. And I do think most of the credit decisions will still be made by bank-like institutions. And how you sort of, do you think about the fintech as a vendor, or are they the marketing arm for the bank, or do they have the customer relationship? I mean, those are all interesting philosophical questions. But at the end of the day, I think the banks will still have the deposit liabilities on the balance sheet, and they'll have the loan assets on their balance sheet.
Great. Well, thank you guys for coming in today. We appreciate it, and who knows what November will bring, but at least I know you guys will be prepared, and hopefully everybody else. So thank you.